Welcome to Innovation Leadership. I'm Jess Larson. On this episode, we get to have Kimberly Flynn. She is founder and president at Zeia Investments, $1 billion plus in assets under management. We're going to learn about interval funds. We're going to learn about alternatives. Coming out of years in Morgan Stanley and then at $1.3 trillion Nuveen, where she helped raise $13 billion for products she helped invent over there. Kimberly, thanks for making this happen.
Thank you, Jess, for having me.
So let's start with your background. Like, what's your story? How did you get here? What are advantages of the way you grew up?
I came from Oklahoma, so that's where I was raised. And if you're a young lady in Oklahoma and you're ambitious, you can be a lawyer, a doctor, or an oilman. Or maybe a TV journalist. So for a long time, I thought I'd be a TV journalist. That did not work out. But, I told my mother that I was leaving Oklahoma and never coming back. I come from a family of doctors and, they can live like kings in Oklahoma. It's a lovely place. Cost of living is cheap. But I love Chicago. I've been in Chicago for 25 years. And, have always been in finance. I think I ended up here because I didn't want to be in New York, and my husband said no to Texas. So, but I love what I do because I get to learn about so many different asset classes, and I didn't have the stick-to-itiveness to actually be a equity portfolio manager. I did spend a summer in equity research, but figured out that raising money was a lot more fun.
Well, it's something that the CEOs and founders and fund managers that listen to this show are endlessly interested in. So can we start with Nuveen? Can you talk about helping raise $13 billion?
Yeah, Nuveen is the market leader. Between BlackRock and Nuveen, they go back and forth in terms of their leadership role in the listed closed-end fund market. It's a very niche market. Most people probably have never heard of it, unless you have a lot of muni bond fund holdings. Because the origins of that market, those products are income-oriented municipal bonds. If you're a wealthy individual, you've probably got a lot of munis. So Nuveen's heritage was a municipal bond heritage. When I came to Chicago, I wanted to work with very smart people, and I'd already decided that I wasn't going to be an equity research analyst. So I had no idea what a closed-end fund was. But I spent 12 years there, same job, 10,000 plus hours building these types of registered closed-end funds, which the whole goal was create regular income for retired investors. Building upon Nuveen's municipal bond heritage, we expanded into a variety of income-producing asset classes. So we got into some pretty cool things like, currencies, commodities, CLOs, so a wide variety of assets, all of which pay regular distributions. And so that was really a lot of fun to expand what Nuveen was known for, and $13 billion over 12 years. We were launching funds. Our funds were sold almost like corporate IPOs, right? So they were only available for 30 days. And so there was you had to get the timing just right, for launching new products. So it was a lot of fun. It was building upon the investment banking career that I had put behind me at Morgan Stanley. But it still had that capital markets driven nature for capital raising. And it drove me, I loved the project nature of you'd spend 6 months focused on farmland or focused on commodities, and then you'd move on to the next thing. So that for me, Nuveen was a really great foundation, terrific mentors, and it led me to doing something a bit more entrepreneurial when I left, because Nuveen was such a great place. Like why go work for a competitor when it was really just time to go and start something new?
Yeah. So a lot of the people in my world, when they hear closed-end fund, they're thinking a 10-year venture fund, a 10-year PE fund, a 10-year commercial real estate fund. And most of them think about trading commodities. They don't understand an income stream coming off commodities. Can you talk about, like, is the period, is this 10 years? And so many of those are like we're going to give you payments in the end when we sell a company. Like, this is definitely not regular income. Can you help us understand a little bit more about what that product looks like?
Yes. So I've spent my whole career, 25 years, in what we call the registered fund space. So think of your typical mutual fund or ETF that you probably know well. Um, the registered closed-end fund is different than a private fund that also is referred to as a closed-end fund. But a closed-end fund that's registered on the SEC, it's basically a sister to a mutual fund, except it's suitable for private market assets because there's not a liquidity requirement. Mutual funds, ETFs, you need to have liquid guts, stocks, bonds, things that can be sold because you're basically, you have daily NAV on a mutual fund, you have intraday trading on an ETF. A closed-end fund is different, a registered closed-end fund. Most of them are perpetual in nature, so they don't have terms. And if you think about the earnings calls for Blackstone or Apollo or KKR, you've heard them talk about evergreen permanent capital and what it does for their business. Well, in the registered fund space, the closed-end fund is the vehicle that they're using because it's evergreen in nature, it's perpetual. And there's a distinction between, there's two different types of closed-end funds. One is a listed closed-end fund, and that's what I was referring to, Nuveen's leadership role in the listed space. Those are listed on the New York Stock Exchange. So even though the portfolio is closed, liquidity comes from buying and selling on the exchange, very similar to an ETF. Right now, all of these alternative asset managers, both leading firms and boutiques, are very hot on something that's called an interval fund. But it is a registered closed-end fund that is open. So it's a total misnomer because they're continuously offered and they keep growing. And so there's a lot of, we'll talk about that, but interval funds are just simply another type of closed-end fund that the interval nature refers to the liquidity window. And the intersection between the private fund space and the registered fund space is simply that a lot of institutional-only private fund managers are now paying attention to the registered side of the market in a way that they really didn't need to and didn't care to in the past.
Interesting. And where is the ongoing income stream in currencies or commodities?
Okay. So with both the currency strategy and the diversified commodity strategy that we were running at Nuveen, they were trading either options or futures and forwards, so derivative-based cash flows. So if you obviously most commodities are not producing income of any sort. There's an interesting gold income ETF in the marketplace. We had the idea before that was brought to market, but same way, they're basically selling derivatives off of the gold underlying to produce a monthly cash flow. And so the return for a product like that is a combination of what the underlying is doing, the gold, and what the derivatives are doing. So I would call that manufactured yield. But if you're a retired investor, you may not have, you may not want to sell your gold, monetize it, and use it, because an investor on their own could create their own cash flows, if you will. But with total return type investments, having a product that manufactures a regular yield serves a need in the market for investors who are typically are buy and hold type investors. And so it's interesting because you have fixed income, which has natural yield, and then you have some of these more derivative-based yield products like currencies and commodities.
And that yield is primarily the profits on the trading activity, just to clarify?
That's right. So you may have gain loss in the underlying, like in the gold itself, or you may have a gain loss in the options position, for example. So take the easiest example is like a classic covered call where you're long Microsoft and you sell a call option. And so the long position in Microsoft it can be offset because the covered call is going to cap your upside in Microsoft. So you use it to generate some cash flow. And there's a lot of advisors and investors who love covered calls because it's a form of hedging the equity position. They want to have they want to have some upside in Microsoft, but they're going to give away upside beyond a certain point. In exchange, they'll get that cash flow. So for risk averse or income oriented investors, this whole space is really booming, the derivative based income products. There was an interesting article in the Wall Street Journal called Boomer Candy. If you look up Wall Street Journal Boomer Candy, it talked about all of these hedged equity type products. And the Boomer Candy part of it is the cash flow, right? Which is what a lot of retirees are looking for.
Yeah. Oh, that makes sense. Let's switch gears. Let's talk. Well, actually, I want to hear one or two of the principles that you felt like served you the best in helping raise that $13 billion.
Well, we always talked about, because of the IPO driven process, these listed closed-end funds were underwritten by investment banks. So you'd have a Morgan Stanley, which is the leader in that market, or a Merrill Lynch. So these products are institutional, first and foremost in quality. It's not like in the ETF space today where you see a lot of thematic ideas. Some of them are tested, some of them are untested. With an underwritten IPO, it's a very rigorous due diligence process. So you're getting a product that's been fully vetted. And Nuveen was better than most at anticipating. The reality is you have to predict what's going to sell in 6 months, and then you have 30 days to sell it. So there is a bit of an art to where's the market going to be in 6 months? It's hard to say. Now, Nuveen had the benefit of municipal bonds because the reality is that's an evergreen demand from a retired investor base. So you could always fall back on something of that nature. But we got pretty good at anticipating where that demand was going to be. So the why now, why would I buy this today? You have to get that timing just right. So we always talked about, for a successful offering, you had to have the moons and the stars and the planets all had to align. And so that was really what Nuveen was very good at and we could build a product very, very quickly in response to market demand. So that discipline of the process, understanding what advisors want for their clients, that's carried me forward in terms of the business that we've built here. I always say it's the same process. It's just applied now to private markets and alternatives, which have, frankly, more asset class specific problems and issues, things like valuation. How do you get to a daily NAV on assets that are not valued on a daily basis? We didn't have that problem necessarily when we were doing covered call equity closed-end funds. So a lot of those first principles that I learned at Nuveen, and then had the opportunity to practice, right? We did 45 IPOs in the time that I was there. So it allowed that refinement of ideas.
Yeah. So let's talk XA now. So can you give people a scope of your funds, the consulting, what's involved in the business, and how you got that over $1 billion?
Sure. So as a brand new asset manager, we joined an investment bank. There's not a lot of crossover between the parent company and the business that I run. But we do have a shared broker dealer, which is nice. But the business originally was, let's replicate the success of what worked so well at Nuveen. Let's launch these permanent capital vehicles, listed closed-end funds. And so the first play from scrimmage was exactly that. We launched a listed closed-end fund in partnership with UBS. And that fund is now, we launched it September of 2017. It's now $850 million in size. And it's a very different fund than what you see in the traditional listed fund environment. It is structured credit, and it's very high yielding. So that attracts a different type of buyer. And so I call it there was a lot of love and care put into the launch of that first fund, but it was everything that I thought we should be doing in terms of product design, but also supporting the fund. But what happens a lot with a new product offering that with an IPO is you list it on the New York Stock Exchange, you raise the capital, and you walk away, and the funds don't get supported. And a lot of listed closed-end funds get a bad name because they can trade at discounts in the secondary market, and nobody likes that. So the fund that we run has traded on average at about a 3% premium, and that's with a lot of focus on driving new demand, bringing new investors into the fund. So for us, it's not a stale initiative. It's every day we live and breathe that. So it was what is the role, sort of it serves as a role model for future funds. We now have 3 funds on the platform, but everything we do is in partnership with outside investors. I'm a product design expert. I am not a portfolio manager. And so we have the opportunity to go out and partner with these asset managers. And a lot of firms just want to run institutional money. And if you raise a 850 million AUM fund, that's a very large institutional account for an asset manager. And so there's a lot of sub-advisors who are happy to partner. But the reason we have a consulting business is there's plenty of firms that do not. They want to control their own fate. They want their name on the product. And in chatting with them about product opportunities, plenty of them said, hey, listen, this is really interesting, but I want my own thing. Can you help me? And so we apply that same process that we've always used in building products for ourselves. We help clients do that for themselves. And it's really, the reality is we meet people where they are. I can't convince you, first of all, this is an initiative to go raise capital in an evergreen type product. So if you want to partner, great, that there's a way to do that. If you don't, we'll help you and consult and just be part of your success that way.
So backing up for 1 second, my friends in tech or who run agencies, advertising agencies, stuff, help them understand what is structured credit and what is it not.
Oh, well, structured credit, think about part of the reason why we call it structured credit is the category includes things like ABS, MBS, CMBS. So these are asset-backed. This broader category includes basically products that have been designed to create cash flow for shareholders, but the underlying, what's in the portfolio, in the case of RMBS, it's residential mortgages. In the case of CMBS, it's commercial mortgages. And so the part of the structured credit market that our fund focuses on is the CLO debt, CLO equity. So CLO is an acronym for collateralized loan obligation. And what is underlying is bank loans and broadly syndicated bank loans. There's also a part of the CLO market, which we don't focus on, for middle market companies. So loans to middle market companies are put into a middle market CLO. At CLO, all of these structured credit vehicles or securities effectively have some degree of leverage because they're pooled investments with leverage and they're structured by a bank or an organizer for cash flow. And then typically there's a capital stack. If you're risk averse, you'd be high up in the capital stack, investing in high quality securities. But if you're a risk taker, you're going to go to the bottom of the stack, which is the most high returning, highest risk. So in the case of collateralized loan obligations, CLO equity, you're the residual holder after all the debt holders get paid out. And CLO debt in the marketplace today yields about 10 to 12%, very attractive. CLO equity in the market today is yielding north of 20%. And that is due to the risk that you're taking on. It's also due to the fact that you're in a leveraged vehicle effectively. So structured credit is really interesting if you look at how structured credit has performed prior to the great financial crisis, a lot of these structures were tested. CLOs stood up to that test and performed very well. Not the case necessarily for some forms of asset-backed, like, for example, RMBS or CMBS. So you have to be very careful when investing in structured credit to make sure you understand what performance is going to look like in a good market and a bad market. But it is an interesting area for income investors given the higher yields that these securities produce.
Over my career, I just have not spent much time in credit at all. I mean, I've got friends and business partners in like private bridge lending, essentially hard money lending on real estate developments and stuff like that, and do very well. And I'm a real like Warren Buffett nerd. So by default, I'm a Howard Marks nerd and love his books. And I feel like I know like the tiniest bit about a credit from being obsessed with everything Howard Marks has ever said. But I'm definitely not an expert there.
Yes, and the legacy carries on at Oaktree, Brookfield. They've got several interval funds and really great credit products. But there's the universe of private credit is broad. It's the biggest category, and so there's a lot of different opportunity sets. Just what you're talking about, Jess, though, there are more niche lending opportunities that are coming online. Things like aircraft leasing, some specialty type lending. And the benefit of having asset backed is that there are assets that you can look to in the event of default. So some specialty lenders, to the extent that they come into the registered fund space, it really opens a lot of doors for people who may not meet the minimums to invest in a private fund.
Well, that's so interesting. So I want to talk about on the consulting side. So I've got a friend with I think he's got $680 million in his commercial real estate fund. Or let's say that I could get my evergreen fund. Let's say that I could grow a fund to kind of over that 150 million range where it can start to cover the fees, to potentially convert from private, paying my quarterly checks to my real estate investors to an interval fund. Can you help me understand like what's legal probably going to cost, and what are the fee structures, and what kind of management fees can somebody like that charge?
Well, let's start with the good news, which is management fees tend to be fairly attractive from the asset manager's perspective, because it may not be, 2 and 20 if that's what you're charging on a private fund. The average management fee for these types of alternative interval funds is about 150. So a very high base fee, that would be relative to a mutual fund, which might be closer to 80 basis points, or an ETF, which would be south of 50 basis points. So to the extent that, you have institutional fee schedules, you can usually preserve those in these structures. There's also the ability to charge either an income incentive fee or a total return-based performance fee. It will have suitability implications if you charge performance fees, but it opens the door for a lot of high quality firms. I like Hamilton Lane as an example. They have a number of registered interval products, but they charge performance fees. So that way everybody's getting the same cooking, right? You want the strategy to have the integrity, but the fees are the same too. But only certain investors that meet qualified client suitability thresholds can go into that product. But that's okay. People self-sort. There's a lot of firms that are trying to go down market, if you will, to serve the lowest common denominator. I mean, listen, the burden for retirement is on everyone's shoulders, and people need access to higher returning private market alternatives. So there's a lot of product innovation trying to go broader, because the truth is most wealthy individuals have wealth advisors who have them in very attractive drawdown or evergreen private fund vehicles. And the opportunity that the asset manager sees is to broaden and diversify their revenue base. And so your example, though, is relevant because in the real estate debt space, we've seen two interval funds, one by Redwood, one by Pender Capital, what they did to get going in the registered space was they took a private fund that they had and they contributed it to the registered fund. So it really accelerated capital raising for them because that way they weren't starting at $0. And some of them are able to preserve their track record if when you come over. You want to do a tax-free reorg so it doesn't harm the investors that are in the private fund. But that's some of the work that we do on the consulting side to help people figure out the best starting point. Some firms have legacy funds that they could convert. Some of our clients will stand up a brand new private fund. They'll go out and market it for 6 to 12 months. Let's say they try to raise $100 million. They can do that in the private fund format and then convert that over. The reason for that is it really de-risks what you're going to do in a registered fund because it's pretty cheap and it doesn't take that long to stand up a private fund. I think we shock people sometimes when we tell them how much it costs to launch a registered fund. So to your question, the organizational expense, it's mostly legal expense. It's north of $500,000. It can run up to $1 million. It doesn't have to, but we try to negotiate legal fees on behalf of our clients to economize there. Now, the reason, typically that's a fund expense, right? Organizational expense. In this market, because everybody is so excited about selling their product, most fund sponsors are covering the organizational expense. They're not putting it to the fund. And, it takes a good 6 to 12 months to build and launch one of these products. So the it's a significant undertaking. And that's why these private fund conversions really, I think, help greenlight launch decisions because they know that they'll have a base upon which to build. I think that helps given the outlays that you have to make.
So I want to go back to a few of these things. When you talked about Hamilton Lane and by charging a performance fee, it limits the investors to qualified purchasers. Are we talking about accredited investor is personal net worth of $1 million, not including home or $200,000 a year over qualified purchaser, like net worth of $5 million, that kind of qualified purchaser?
Yes. Yeah. So in this case, there's a qualified client in between. So a QC is basically like 2.2 million net worth, which is actually pretty low. I mean, the AI suitability threshold is pretty low. So QC is sort of in the middle. You don't have to be a QP. You don't have to be a qualified purchaser the way you might for a private fund. And so in that sense, Hamilton Lane was able to broaden out their investor base from QP down to that 2.2 million, that QC level. And they were satisfied with that, especially given their distribution strategy, which is to partner with wirehouse firms, which have a lot of wealthy clients, family offices, and larger RIAs with higher net worth clients. So for them, it was a sufficient diversification of their audience, but preserved their fees. I'll tell you on the private credit
just
side.
Quickly,
Yes.
What kind of performance fees? You said it's not 2 and 20, it's 1.5, and then I didn't catch the.
Yes. So we've run the comps for that category of private equity funds where Hamilton Lane sits. And the fees on the base management fees are typically anywhere from 1 to 150. And then the performance fees are typically either a 10 or a 15%. Very few of them will actually go to market with a 20% performance fee. And usually there's some sort of, return threshold there for performance. So the fees
like
are
a preferred return and a catch up, or not no catch up?
Like a catch up. Yeah, a catch up.
What kind of pref? 6, 8, more?
They're in that 6 to 8 range. And what's surprising is with interest rates moving so much higher, we didn't actually see those preferred returns move that much higher. So in some ways, the hurdle got easier, right?
Yeah, interesting.
Because they didn't move up that much, right? Yeah.
And what ratio would you say are at the 10% performance versus the 15% performance, or in between?
The mode is 15, right? There's a few in this space. To the extent you're a fund of funds manager, most of the fund of private funds will try to preserve their 1 in 10. But the truth there is that most of the fund of funds are just going to charge a flat base management fee, because like anytime you have that acquired fund expense, it's on the expense table. It comes through on a delayed basis, right? Because you have to realize the return for the performance piece of it to come through. So those acquired fund expenses, while you have to disclose them, I don't know that retail investors fully understand, once performance is paid, your all-in fee might be 7% or something, right? But I think the argument is the alignment argument, to the extent that, because I think there's some question about the additional liquidity that these funds require, and cash drag, because they're not drawdown, they're evergreen. And so judgment is still out right now. Half the market has 3 years or less in track record. It's a fairly new market. And so just as private funds and mutual funds, performance is going to sort of rule the day. Hamilton Lane is able to rely upon their institutional track record, and they're able to communicate that. But some of this will shake out in terms of what the 5 and 10-year performance numbers look like.
And so thinking about that, well, I have too many questions. It's funny, this is a lot more technical than a lot of episodes, so I'm sure we're losing people, but I'm loving it. So so I want to talk first about if somebody does want to go retail. Is it more like they're taking 100 points on a management fee and no performance, or what's kind of the average?
Yeah, the average is for a flat management fee. The mode is about 150. It's probably going to come down. I don't think it'll come down. It's not going to come south of 1. The market leader for this market is a firm called Cliffwater. They charge a 1% fee, but they're running a 20 billion AUM direct lending credit fund. And so I think that their goal was to be a market leader, not just on performance, but on price. Most alternative boutiques are not in that sense. They're a bit of an outlier on fees. So I would say that most of the asset managers that we speak with are happy with the comp set. They're able to justify the fee that they want to their board, but also to shareholders.
And for people not following this, you're saying, like, why would somebody give up a 15% performance fee? And the
Right.
point is, because if we can build our asset base that much,
Yes.
1.5% on 20 billion compared to 1.5% plus 15% on 2 billion,
That's right.
from a total comp to the GP in the end, kind of.
That's right. I mean,
right?
yeah. 1% on 20 billion is a lot of money for Cliffwater. They are an institutional consultant, but the success that they've had with these funds has driven them to basically split the business, if you will, because this is so much more lucrative for them. And I think that a lot of firms find that when think about the retirement market 50 years ago, everybody had a pension. So those are defined benefit programs. Defined benefit programs have gone away. Corporate America doesn't have pensions. So we have 401ks, which is part of the defined contribution market. But 401ks that chassis was built on mutual funds. Mutual funds don't have access to private equity or venture capital. So this is solving for a really acute problem, because pensions and endowments, the Yale model, Dave Swenson, is you put 50% in long duration real estate and private equity, and you have to have a longer investment horizon, but the returns and the diversification potential is going to pay off. So an individual investor is not going to be investing like Yale, but some of the opportunities, especially if you're starting to save for retirement in your 20s and 30s, you have a 30 to 40 year time span. So that's why it's essential for investors to have access, but it has to be easy, right? It has to be as easy as buying an ETF or a mutual fund. And so that's what the industry is coalescing. And management fees are probably going to come down but these institutional money managers, the pool of capital is shrinking for them, right? The truth is that they're all waking up to this reality that institutional money pools are in decline, and the retail pools are expected to grow, according to McKinsey, by 20 to 30% compounded. And so that's why there's such a shift, and you'd be willing to give up some of your fee if it means raising more assets. So that's a lot of conversations behind closed doors for firms that have been institutional only up until this point, because it's a very different service model to serve, individual investors.
So most of my friends in the fund world are on the private side. Some evergreen, most closed-ended, right? If I'm introducing this concept to them, and they've got a closed-end, 10-year real estate fund, they're building multifamily, lease it up, take some cash flow, sell it, or private equity, buying mid-mark, doing a roll-up, and then exiting to the next tier up of private equity over. And I'm trying to help them understand like what the interval product is and why they might be interested in it. What should I be telling them?
Well, I think part of the reason that there's plenty of investors who hold private funds that are also investing in interval funds. Interval funds are referred to as semi-liquid, to the extent that you're looking for a product where you would have interim liquidity. You might be in 10-year drawdown funds that you have to wait to the termination of the fund before you're going to have liquidity. And so there are clients that like that, and to the extent that you meet certain minimums, you might be able to go into the institutional share class. And so I financial advisors, though, are serving a wide variety of wealth clients. And what we hear from family offices might be relevant for your sort of focus group here, because family offices, they have to build diversified portfolios, not just for the patriarch of the family, but they need to build it for the second and the third generation. And, maybe, kiddo number 5 only has a $2 million, trust account or portfolio. So you're not going to put them into private funds. It's going to be a lot easier to facilitate a diversified private markets allocation with an interval fund. So I think that because it makes it so much easier for the financial advisor to serve wealthy clients and the next generation, I think that's what is going to cause, in some ways, to supplant some of the private market exposures, just because they're going to use it across clients, and they themselves, most wealth managers don't love the paperwork involved with subdocs, and you got to track down your clients who are traveling all over, and so the ease of purchase is another thing that these advisors like. And so I think right now we're starting to see some of the interval funds move up market, if you will. The wirehouses that serve a lot of in their private banks, they've been asking private fund sponsors to come back to them with a registered fund alternative, partly because if you think about, if they're going to onboard a new private fund and only a small segment of their population can afford or meet the minimums, and the gatekeepers are going to be driving a lot of this. Their preference is, bring a product on with a 1099 that can be sold to many more clients. And so that too will change where institutional managers focus. I'm not saying they're going to stop offering their private funds, but they're going to almost be faced with having to do both, because the RIA and the wirehouse gatekeepers are going to be demanding it, because it's that much easier for them to implement as well.
Reducing friction is a great way to make money, right? For people outside the industry, who are wirehouses and who are not wirehouses?
Oh, so Morgan Stanley, Merrill Lynch, think of the big brokerage houses, UBS, Wells Fargo, so firms like that. But then also there's other broker-dealer firms that you probably know of, Raymond James, RBC, Wedbush, all of these firms that have large wealth management practices alongside their investment banks. They're trying to, wealth management, look at Morgan Stanley's financials. That's where the revenue and the money for them has been made. And so if you think about the focus on wealth management, a lot of the talent, is leaving the investment bank and going into the wealth management side. So this is a very lucrative business, and so I think it's driving a lot of the focus on creating. Part of what wealth managers like about these products is they're sticky and they keep clients, in the funds and with their financial advisor. That's kind of the other side of it.
It's always great to scratch your salesperson's back, right?
Or be aware that they're doing it,
Yeah. So again, talking to the fund manager who's thinking about converting their, $100, $250 million fund over, let's call it, somewhere between 500 million in setup costs. What are their ongoing regulatory obligations going to cost them in legal and filing fees? And, what would be like guesstimate budget on third-party fund administration or things like that?
Yeah, the nice thing is that for an institutional money manager that doesn't have any existing mutual funds and whatnot, they don't have the back office or middle office. A lot of the functions to support one of these registered funds can be done by outside service providers. And so at Nuveen, a lot of it was done in-house by employees. But for alternative boutiques, if you engage a fund administrator, a custodian, you can also engage optional service providers would provide compliance services, principal financial officer services. So when we do consulting, we advise that oftentimes an existing employee can be tasked with, it's really not full headcount. We're talking fractional headcount. Sales is usually where you actually have to add, one or two new people to start that sales effort in earnest. But it can be done with existing personnel. It can be done with outsourcing to good service providers. And frankly, to the extent that you do outsource it, it becomes a fund expense as opposed to headcount that you're going to have to pay for with your own budget. So that's part of what we do with each of our clients is we figure out helping them put together a budget, not just for the build, but for supporting the product, and then figuring out what, if they do need to add headcount, where that might be. But, it can be done with a part-time person or allocating time from an existing ops person. So when we started our firm, for example, we were 3 people. So it doesn't take a huge sort of team to the extent that you're able to have good service providers.
Yeah. So, even if it is a fund expense, that obviously is a drag on returns. Just thinking about a budget, again, somebody's starting off, they're coming over with their first 150, it's $500,000, $750,000 to start or something. What should they anticipate for kind of like the ongoing costs in those first, 2, 3, 4 years?
Yeah. So you in terms of outlays, in addition to the organizational costs, which we put at about 500,000, typically it's anywhere from 150 to 200,000 in fee waivers for expenses that you would waive, and it puts your break even typically somewhere in the second or the third year. It just depends on how quickly you can scale. Now, this is a perpetual fund, so the early days are sort of mission critical for scaling the fund, and it's also when most of the expense and the outlay is hitting you. You can speed that up in terms of taking away some of the pain. If the starting point for the fund is 100 million because you've contributed a private fund, or maybe 200 million, it just speeds up how quickly you can raise outside capital. And so therefore it can move your break even, from 2 years down to 18 months or something of that nature. And some firms that scale very quickly actually are able to then put some of these expenses back to the fund. As you note, it hits expenses and hits returns, but it's one of those judgment calls that you make in terms of balancing where you are in the sales cycle with the expense load that the fund is bearing. So I think that while it's not an easy thing to do, and you do have to have a medium sort of to long-term mindset, it's not like a thematic ETF where you can open it up and, raise 200 million on a single day. The capital doesn't come in that way.
And so thinking about what that ongoing burden is this a, basis points against AUM? Is it, it's going to be, no,
Yeah.
it's just probably going to cost you another 300 grand a year, another $1 million a year, or like what, how does somebody think about that who doesn't know anything about this?
I think the budget or the mindset for thinking about what it's going to cost you to run the fund is that we also, in setting the management fee for the fund, what we try to get people to do is because there's a to the extent that you're selling into multiple distribution channels, there's a lot of parties with their hand out wanting a cut of the fee, rev share, custodial platform fees. And so sadly, some clients have come to us and said they set their management fee too low and now they're paying out of pocket. So you have to get to a net fee that you're going to take home once you've addressed all the distribution platforms. And this market, in addition to wirehouse banks, which we already talked about, a lot of the advisors are independent advisors, and they only want an institutional share class. So they want it clean. They don't want a lot of other fees to it. And so that's why, as opposed to being surprised later on that this is coming out of your pocket, we want firms to be thoughtful about where they set the management fee on the front end, because your board is never going to authorize an increase to your management fee, right? You got to get that right. So I think that's also what's contributing to, we're not, with the exception of Cliffwater that I already talked about with their flat 1%, most funds, their management fees are 150 for good reason, because there are these things that are going to hit them, and it's going to come out of their management fee.
And so thinking about that 150 basis points or 1.5%, what do you think they're netting out of that 150 basis points?
Yeah, I mean, so simply you'd back out the custodial platforms at about 25 basis points. So many of them are going to be netting somewhere between like 1 and 115, right? If you're talking about a 150 flat. And it's a lot more, the market's comprised of traditional mutual fund sponsors, which have seen a lot of margin erosion. Their mutual fund businesses are dying. And so this appeals to them because at least they're able to charge something that might hold up to a bit more fee pressure for a while. But, I think that's why I don't mind some of the incentive fees that I see, because you start to wonder about, well, am I getting the same strategy as I might in a private fund, if it's that much cheaper? So that's what we were talking about, is that, judgment is still out on that. And it's right to be concerned, because there is a trade-off. If you want liquidity, you're dealing with things where there might be differences in the strategy. There might be cash drag.
Well, and this is my gripe a little bit with some of the one-sidedness, maybe sometimes from the RIA world or some family office managers, is like, you brought up Brookfield before. I think it was Bruce Flatt who said this. He was being asked about, like, or maybe it was Howard Marks, or I can't remember. They're talking about like pension funds and compensation, and people who keep cutting fees, and even on the private side. And he said, well, like, you can have all your theories, but then look at American pension funds where you can't compensate these individuals in the millions, and then look at the Canadian pension funds where they can, and just look at the performance difference. Like, if you're that good at investing,
Right.
Are you not going to go work where you can make the most?
That's
so
right.
You can,
and
you can think you're controlling so much by controlling the costs and all the fee pressure, but you're by default also pushing the people who are talented enough to get the high fees to go to Blackstone, to go to these places that are going to put millions and millions of dollars in their pocket for this talent that they've spent so much time mastering.
Yeah, I agree with you on talent fluidity. But the other thing is that there are capacity constraints, and we don't hear people talking about, if this is the thing I worry about with private equity and so much dry powder, everybody's chasing the same deals, you're going to pay more. And we see that all the time with private equity paying more than strategic corporate buyers. So I would love to see people talking more about the capacity constraint. I'd love to see people cap or close their funds to protect returns, right? But to think that in private markets that you're going to be able to deploy 5 billion as effectively as you are 500, I think that there effectively at some point you reach return deterioration. Maybe it's slight, but there needs to be more conversation, and investors need to be asking about that, because I mean, there are capacity constraints on public equities, and there's caps in mutual funds all the time for that reason.
Well, and this is, so this is like a hot button issue for me. Is I look at, just look at, you look at like a Blackstone or Brookfield who've been able to grow platform, total AUM over $1 trillion each, right? And they took 30 years to get there, not 30 months, right?
Right.
But you also look at some differences of like how they operate themselves. I mean, think about like back in the LBO days when it was just like buy something, throw an absurd amount of debt on it, do a little bit and resell it. Those days are over, right? But this is just me, and I'm happy for other people to argue with me, but I think some of like the post LBO insanely leveraged private equity world days, like it does feel like we're entering a new era a little bit, just because of what you said. Like, doing the same thing as other people is not a recipe for high margins, right?
Yeah.
Because it's a race to the bottom on price, or if you're the buyer, going the other direction, right? I think it's one of the reasons that I love Bruce Flatt is like, he's like, we are not just asset warehousers, we are operating investors. And we are like dedicated to operational excellence. This is not just spreadsheet increases in values. We are like actively showing up and tangibly transforming a business with our own hands and our literally hundreds of thousands of staff. And they're an operating entrepreneur. And it does feel like folks who are willing to do that extra effort. I mean, let's face it, it's easier to sit in your fancy building in New York and do it all on Excel, right? Those folks who are willing to get their hands dirty are willing to, be a little bit more of an entrepreneur instead of an asset warehouser. I'm more bullish on those. I don't know if you feel differently.
Yeah, well, I do. That's why I have a lot of respect for firms that originate. You have a lot of real estate focused debt they originate all those loans right there. And in the credit space, you have firms like Golub and Monroe, and they are very in high demand because of their origination capabilities. So they can do what other lenders can't, who are just following along or part of a larger club deal. And so totally agreed that that's what makes certain types of strategies a little bit, I guess, more special, but also protects their returns, right? Because they're the ones as originators, deciding on the terms and provisions of that deal. So we do see that, and I think that in infrastructure and private equity, as those fund sizes get larger and larger, I know they can take control equity type positions, larger positions, but you do wonder as the scale increases, whether or not you're going to have commensurate returns, that you did before. So that's why I do like to see it originating.
And I think to me, the vote, again, regardless of opinions, if you look as an industry, those returns have been compressed. I mean, I feel like all I'm doing is talking about Howard Marks this episode, but he says some of the worst words in investing is too much money chasing too few deals, right? I mean, you've seen that return compression across a lot of average private equity, right? I want to go back to interval funds for 1 second though. So somebody was like, okay, I run a, quarterly cash flow evergreen fund or open-end fund in real estate. If I become an interval fund, like, is this, how often do we have to calculate NAV? What do redemptions look like? How different is this than running like a a B REIT, private REIT, can you give us just a little more details there?
Yeah, I mean, there's a lot of parallels between running it to the extent it's a registered, like a non-listed REIT. There are a lot of similarities in running an interval. Like the interval fund, it can be a REIT for tax purposes too. So to the extent you're in real estate, it doesn't have to be what we call a RIC. These are both pass-through type entities. So there's a lot of parallels there in terms of how you would build these portfolios. Um, I think the areas though of differences between a private fund and the registered interval fund is you can have a daily NAV, you can have a monthly or quarterly NAV. So you have choice on frequency of NAV. It does depend on the underlying assets, depends on if you're going to do it in-house or if you're going to have a third-party valuation agent come in. Most of these funds are providing quarterly liquidity. So that's why they're kind of dubbed as semi-liquid. Now that comes with a warning label because if everybody wants liquidity, you can be prorated. But the market right now is largely quarterly for 5%. To the extent we see more hedge funds or more funds with liquid securities, there's a limit, right? A hedge fund makes a lot of sense given the positioning of most of the hedge fund sponsors, but the SEC doesn't want to see the interval fund wrapper used for highly liquid securities because you're locking people up for a period of time, right? Like there's limited liquidity, so you should have justification around the strategy use. But the interval fund market is broad. You name the private market asset, it can fit or will fit. We don't have dedicated farmland funds. We don't have dedicated like energy transition funds. So there's still a lot of white space in this market for private fund sponsors who are considering entering. There's a ton of private credit because everybody wants yield, but there's a lot of variety of credit, so I'm not particularly worried about there being too much just yet. And so many funds are early in their fund history. And, the quality of the managers and the strategies will shake out with performance. There's only 265 funds, which sounds like a lot, but 100 of them have been launched in the last year and a half. So they're babies, and we'll see. They're in their infancy, so we'll see how they grow. But in the last year and a half, a lot of really high quality firms, have dipped a toe into these waters. We talked about Hamilton Lane; they came earlier, but firms like Wellington, they're launching a global multi-strat hedge fund strategy in this market. So we'll see a lot of really interesting alt boutiques enter in 2025.
Well, thinking about your own personal success, there's so many folks that are in finance that would like to achieve what you have and haven't. What do you think you've done different, or what's different about you?
Well, I think that for some of us, you have to get over the risk aversion of pursuing your own business plan or your own idea. And there's a lot of ways to start a business, a lot of ways to get backing or financial investment into the business. And so I'm glad I didn't wait too long. My mother's an antique estate sale. So I always point to this arrow because it was sort of the arrow in my head. I found this at a estate sale. But, I think you have to sort of look for those, moments. And when you see an arrow or an exit, take it. But I talk with a lot of friends who work in asset management, and they're quite risk averse. So I'd say I've failed in recruiting any of my former Nuveen colleagues. But part of it is when we're comfortable, we're not willing to take some of those risks. So I'm very glad that I did. And there's a lot of joy in being able to wear a lot of different hats, and being able to decide how you spend your day. It's not really a job. It's a business you're building, and it's a passion to do it. So it has to be a lot of fun. But I think that overcoming, that risk aversion is hard for a lot of us. And I see it now that I'm in my late 40s. I think that there's a critical window that people have before they get too long in a certain role or a certain job. And in the end, the risk is worth it because you end up having more job security because the job is one you've created, one that you've built. And so when hiring young people, I try to get them out of college. I try to get them very focused on figure out what it is that you really are good at and what you really like. Most people don't actually know. They don't know what they're good at and they don't know what they like. But I felt lucky because I knew both of those things. So ask yourself those questions.
Yeah. What's been one of your biggest challenges that maybe you didn't anticipate now that it's your business, right?
Well, it's funny because in finance and asset management, nobody wants to give their money to a brand new firm, right? So this notion of being an entrepreneur, and I do feel like building, I am, but you're not really permitted to say it because nobody wants to hand their money over to a brand new entity. So this is a conundrum that maybe there's other sectors or fields. Having gone to business school, there was a lot of focus on, entrepreneurial pathways, and it's encouraged and admired, especially in technology. I would say the opposite is true in finance. And I've had the opportunity to meet a lot of fintech firms in my day. And running an asset management business or building an asset management business is definitely not the same as building a fintech platform. So both have plenty of merit, but I think, and I think within fintech, you have a lot of technology people who are not asset managers. So I think that's the only difference in terms of the thing I've discovered about building an asset management business is you kind of lie to yourself and lie to the world until you're big enough to tell people what it is that you actually do. Whereas I feel like fintech firms are they're very proud to say that they're a fintech firm, even if they don't have much underlying technology. So it's just, you have to be, I think it's just a difference that exists in asset management when you're managing people's wealth and retirement assets. So it's understandable.
Yeah. Well, this has been so fun, super informative for me. I learned a ton. What do you want to leave people with today?
Well, I'd love to talk with you. If you have a real estate private debt fund that you'd like to grow and build upon, we can help. So if you would love resources on interval funds or you're just kind of curious, come to our website. We've got a lot of research we can share with you, Zeia Investments. I'm very reachable. And, part of the reason we've been very successful in our research and consulting business is we talk to everyone. And I've had a lot of bad Elon Musk and crypto ideas just in the last 6 months. But even if you have one of those, I'm happy to talk because you never know. There's always some interesting opportunities. But that's what I would leave people with.
Yeah. Besides your website, is LinkedIn probably the next best place, or what social?
Yes. Follow me, Kimberly Flynn at LinkedIn or Zeia Investments. We are posting our research almost daily. So especially if you're a wealth manager or you're deploying capital and you want to learn more about the different types of interval funds, follow us there.
I love it. Well, thanks again for making time for this.
Yeah, thank you, Jess. This is great.
You bet. Bye, everyone.